Hey everyone, good morning. Marty Missouri here, July 23rd, 2019. Quick chart analysis for you. Thanks for the feedback. Those of you who have mentioned that you like the chart work that we do here on the video. So this is for you. Hopefully it's instructive and we'll keep it interesting. That said, there really isn't a lot interesting happening from a technical perspective, meaning there's not really much, if anything, new to report. I can point to this ascending wedge. These wedge patterns are among the best in terms of their predictive ability. When they're ascending, the market tends to break out below somewhere, two-thirds, three-fourths of the way through the wedge. And sure enough, this here recently, 4 days ago, we broke down below this wedge, had a big, what would be called an engulfing candle right here, where the body of it engulfs the body of at least the day before, if not a couple days before. That typically is a very bearish technical indicator, although the market is fighting its way higher. It's still within the body of that candle a couple days ago. Dow's up 95 as I speak. S&P's up about 10. If you read the earlier blog, you know that my view is that this is mostly on the deal between the White House and Congress on increasing the debt ceiling. You may recall in years past where that was a big market moving conflict. So here we have our chart, the candle chart, S&P again, broken down below that wedge. We'll see how we resolve this. Could very well resolve higher. As I said in yesterday's blog post, which was not an optimistic sounding blog post, I did say that this market has real upside potential, no doubt about it. However, it is predicated upon easy money and throughout the world. And the question being, can easy money overcome what is really the problem in terms of waning economic growth? And in fact, our macro index, which is something that we score, and it's based on the trends in the data, 84 pieces of data, just scored just over 15 this weekend. A year ago, January, it was 81.5. Gets below zero, we are taking defensive measures in portfolios from an asset allocation standpoint. We're not there yet. 15 is still good. Lowest in terms of our back tests we've gotten during this expansion was during the European debt crisis in 2011, got all the way down to an 8. And that turned out to be, in the long-term scheme of things, volatility to ignore. But we did not have a complete uprooting of global supply chains and palpable uncertainty amid the U.S.-China trade war. Looks like once it's resolved, we'll be inciting trade wars with other people. So while we're still constructive, because the data says be constructive and don't go running for the hills just yet, we have to be guarded in our assessment. Not because we want to be, but because it makes sense to be. So we'll see how this plays out. I maintain that something sustainable well into all-time highs is not in the cards as long as we have protectionism to the extent that we do. It's not just here in the US, it's globally, and then populism as it is finding root in certain places. Populists aren't winning every election, and they're not gaining majorities everywhere. But we should all be concerned, although some of us I know like the populist narrative, in terms of prosperity, in terms of global trade, are being threatened by populism and protectionism. So we'll keep our eye on it. But again, I'm here to talk about the markets. So we have this kind of this rise. We broke down below this wedge. We kind of are consolidating here. The trends in terms of the technicals. Here's your on balance volume. We have an upward sloping trend line. It has flattened out. This all makes sense right here. This would be a negative or a bearish divergence because it's not confirming the upward slope there. So technically, it's not as bad as it was, but it's not a good sign. This is deteriorating. This is your moving average convergence divergence. This is a bearish divergence from this nice long move up here. Very definite. This right here is not where I use these indicators mostly, but the technician's textbook would tell you a crossover of the signal line above the zero line, and you can see it in the histogram here, that is a sell signal for technicians. And so we've got that now very firmly on the daily chart. So we'll see how that resolves itself going forward. And then the RSI, or the Relative Strength Index, rolling over here, bearish divergence from where we were back there. So again, like I said at the beginning, there's absolutely nothing on the charts here that tells us that we need to feel good at all at this point about the 70-point rally right now in the Dow, 6 points in the S&P, so it's fading a bit. With regard to the very short term with the rest of the week, in fact, Thursday is when the biggies, the big tech stocks, announce their earnings. So I think the market's going to be kind of in this, traders holding pattern. You're going to see volatility on a day-to-day basis. You're going to see things happen as the economic data comes in and as more earnings come in. But Thursday is the biggie this week in terms of earnings. In fact, it's a big week altogether. But Thursday, you get your Googles and so forth. Friday is the GDP number, so that could be market moving. If it's a really good number, ironically, the market will probably sell off. If it's a really bad number, it'll probably rally. If it's somewhere in between, it'll probably do okay because the market is discounting at a minimum a quarter point cut on July 31st, next Wednesday, in terms of interest rates. 50 basis points or 0.5%. It'll be interesting to see how the market would react to that. I don't think that's going to happen. Quite frankly, in certain circles, you'll hear this is the best economy the world's ever seen. If that's the case, we should be raising interest rates, not cutting them. But the Fed is going to be preemptive. I maintain, frankly, and this is a tough one, I know, that they really should just go with the data and not cut, and they should let the market fall apart while the economy is still in decent shape. If we can get a big correction, if we can come down double digits here, I don't think the folks who are keeping protectionism alive, trade wars alive, and threatening new ones can politically withstand another correction along the lines of what we had in December. If that comes while the economy is still okay and it puts an end to this protectionist push and gets us onto other things on the political agenda that we should be paying attention to, I think we will have a roaring bull market for the next couple of years and we'll catch our wind, and this will be very reminiscent of the 20% correction in 1998, where we still had virtually 3 years to go in terms of the economic expansion. We did not have trade wars at that time. We did not have protectionism like we do today. That will kill it, in my view, if we don't put an end to it in the relatively near future. If the Fed continues to prop up asset prices, which is absolutely what's happening right now, granted, earnings are coming in okay, although remember, the bar has been lowered exponentially. So it's not hard to beat lowered expectations. But if we continue to keep asset prices higher and don't allow for the market to punish this protectionism, my fear is that we'll get so far along that conditions will ultimately roll over. And the market will roll over regardless of what the Fed does. And ending the trade war may not fix it. So as we sit here today, technically things do not look great. In fact, and I've shown you on the blog here recently, the weekly charts, the monthly charts. I've shown you the broad market versus small caps and transportation. I've shown you the stocks versus bonds. All of these things are showing divergences that are consistent with, at a minimum, double-digit correction phase, at worst, big bear markets. Doesn't mean they're going to happen. There are always false signals in the technicals. So for now, we're going to stay the course with our allocations. We are looking, as many of you know, we are looking at hedging portfolios. So if we haven't had that discussion yet, stay tuned. So look at past emails and watch your emails over the next few days, and you're going to have something from me that I'm going to want you to take a very close look at. I'll leave it there. Thank you, as always, for watching and listening, and I'll talk to you again very soon. Take care.